Think we're live streaming and ready to go. So let's get into it. I have a topic for today: 3 uncommon ways to get or to fill your pipeline this winter. And I do want to spend some time on that, but I want to start with some housekeeping items, some kind of fun, exciting updates, and I also time permitting, I want to dig into something that came up 2 weeks ago at the end of this that I haven't been able to circle back on as of yet. Do me a huge favor if you are watching in the group, the Wake Up Real Estate group. Give us a thumbs up, maybe even drop a comment if you're excited about today's topic. Yeah, thank you, James. And if you have questions as we go through any of today's topics, certainly drop them in a comment, or you can use the chat here as well, whichever is easier for you. I posted in the group yesterday a little, let me see here, a little reel with an update on a postcard, or on the postcards that I sent to the demographic circle prospecting list that we built 2 weeks ago on this mastermind using PropStream. Okay, growwithjosh.com/PS, growwithjosh.com/PS. You can go get a free trial there. Also, we're going to be doing some really cool stuff with PropStream, probably starting in December, but definitely, if not in December, definitely the first quarter of the year. Some cool giveaways, the ability to get some marketing credits, and some fun things lined up with them. Want to kind of deepen the relationship there with them, and find even more ways for us to use the platform to get more opportunities. Anyway, 2 weeks ago, I built out a demographic circle prospecting list around a property that I had brought the buyers to. So it wasn't even my listing. Okay, and there's a lesson here. Wasn't even my listing. And those postcards started to hit Monday. It's a little bit longer than normal. I don't know if it's probably holiday related, like I see I feel, the Amazon delivery people, they're like out all hours of the day delivering stuff. I think it's, very similar for the USPS. Anyway, they started to land on Monday, and I have gotten 10 scans from 146 recipients so far. 10 scans. So that's more than a 5% scan rate. The postcard is very simple. The front is ugly yellow. The back has some of my branding. And I am now working to to figure out which of those 10 are, serious and thinking about selling, and which maybe, are longer term prospects, etc. But one way to look at this is from $106, I got 10 seller leads. Okay, now I had to get the list from PropStream and I skip traced, etc. But just from this piece of that marketing activity, 10 of them from that amount, that's $10. It's pretty good. Pretty good, right? And, for me, the average home price in this neighborhood is low threes to 400,000. That's a pretty good, price in my market, where the average is, depending on if you look at the county or just the whole area in general, but, high twos, low threes. So pretty exciting there. If you missed that session, you should be able to find it in the group. If you can't find it, just shoot me a DM or comment below. We'll get it to you. And if you need help building your list or sending out the postcard, just let me know on that as well. We have ways that we can help you with that. And last thing I'll say on this, I've had a couple of people ask me, some people that have gotten their trial or even are paying for PropStream. Again, growwithjosh.com/PS. And they've asked, where do I start, right? Like, what list should I build? to me, this is the lowest hanging fruit. If you can find a property, whether it's your listing or you brought the buyer, where you can build a demographic circle prospecting list, whether you just brought the buyer and it went pending or you just closed with the buyer, that to me is the lowest hanging fruit. I guess with the caveat, as long as it's an area that you want more business in, right? As long as it's not an area that's too far out of your coverage area or whatever the case may be. So that was kind of fun and exciting. I wanted to share that as an update to last week. Now, the topic that I teased for today, 3 uncommon ways to fill your pipeline with more deals this winter, very transparently is, at least on the surface, mortgage heavy. And what I mean by that is we're taking what I'm doing today, or what I hope to do today, is make you aware of some lesser known mortgage options, and then give you ways that you can use the existence of those programs and the opportunity with those programs to then go either convert clients that you haven't been able to convert, or maybe even re-engage with clients that fell out for one reason or another, or proactively go create opportunities where you have none right now, meaning like that don't exist in your current database or anything along those lines currently. Okay. So there will be a mortgage lien here. And if you want to talk about that, if you have, if you want help with that, we've got a mortgage team. We're with NEXA Mortgage. NEXA is licensed in 48 out of 50 states. Our team is licensed in, I think 12 currently. We dropped some that we just didn't have use for, but it's pretty easy for us to add states if we have a good reason. And if you want to chat about any of that, just shoot me a DM, comment below, text me, go to joshvips.com, whatever works for you. So what I'm going to do, and I have some of the ugliest slides you will ever see that I put together just to keep on topic. I'm just going to open open sort of the discussion, talk a little bit about the programs, but then I think more importantly for all of you, like, how do you use that to actually create or create some new opportunities or build out your pipeline? So with that said, and then I do anticipate having us time at the end to address something that came up. I think it came up on last week's session with Burton. Yeah. And I just haven't had time to address it yet. Fernando had brought up a good question. So 3 uncommon ways to fill your pipeline with clients this winter. Number 1, numero uno, if I can get my slides to work here. Maybe I can't. We'll just go here. One-time close construction loans. One-time close construction loans. Recently, I put together a PDF detailing some of these construction loan options. Now, I built this out to share with my own local database because we have a number of contacts in our database that have either opted in for land listings, or we can tell are looking at land listings, that they're interested in land. And not all of them are looking to build on the land. Some of them are looking for recreational purposes, hunting, whatever. That's, pretty common here in Central PA. But some of them are looking to build. They want to build their dream home, right? And so I put this together, and I will drop this in the chat for those that are interested. Now, if you're going to use this, just make a copy first. Go file, make a copy first, and you can change some of the what's on here. But I titled this, and I don't know if it's any good, 7 incredible construction loan options to build the home or investment of your dreams. And 4 of these options are specifically for owner occupants. Okay, people that want to build a home to live in. But 3 of them are for the investor developer scenario. So the owner occupant, the 4 owner occupant, and you may or may not know this, but it's FHA, VA, USDA, and conventional. And you're saying, well, yeah, isn't that, those are like the 4 most common options. Yeah, but all of those types of loans, you can do a one-time close with similar terms. And it just in simple terms, what a one-time close means is they can purchase the land and get their construction loan all at once. Here's what that means for you as the realtor. I can't guarantee it, but if done correctly, you can get paid a commission, not just on the land. Okay? So you can get a full commission, buyer side commission, and obviously whatever you negotiate, blah, blah, blah. But you can get paid in full when they purchase the land if a client is using one of these one-time close construction options. FHA, you can do 3.5% down one-time close at 580 plus. We even have, and I hesitate to mention this because there's a lot of red tape, but I'm going to throw it out that it is possible. We have one lender that will even do down payment assistance on an FHA one-time close construction loan. What that means is they could theoretically only have to pay the costs of like the settlement costs, right? They could even potentially get their down payment on FHA. For VA and USDA, it's that's a piece of cake. That's 100% financing land and the construction. And it doesn't have to be stick built. Okay. You note up here, available for manufactured, modular, and stick built homes. Okay. So, like for example, in Central PA, we have a couple right up 1115 manufactured and modular home builders that I am working to foster relationships with. So as we get more of these clients, we have more options and solutions for them. Another thing that I've been using this to create conversations around is the smaller, I say smaller meaning like by volume, custom home builders in my market. I had a great meeting with one 2 weeks ago. I think it was 2 weeks ago, sometime in the last couple of weeks. And we had a great conversation. It may turn into some listing opportunities for me. It's already turned into some potential client opportunities on the financing side. Something I don't even have in here. They had a client that they have a home to sell and they want to buy one of their new homes. And so we're looking at the buy before you sell option that we talked about. I can't remember when we had the Home Light rep on, but it was sometime in the last 4, 5, 6 weeks on these sessions. So I guess my point here is like there are lots of options with this. And if you're the person in your market making the consumer, and in some cases, even the builder or the agent with the land listing or whatever, when you're the one bringing this as a possible solution, I don't know what percentage of agents know that these options exist. But my guess is it's not that many, or at least that really know how it works, right? Like if you go find 10 random agents in your market and you ask them, how does a one-time closed construction loan work? They may not have any idea what you're talking about. Okay. And then you can do conventional with up to 97% LTV. So you can do conventional with 3% down on a one-time close construction when you combine it with Home Possible or Home One, which is another sort of special option available. And then this was more, the topic for today was more about those top 3 or those top 4 options, but just be aware for those of you that work with investors or developers or those type of clientele, we do also have options for these types of loans for those that want to build spec homes or even do full developments. I would say it's generally speaking better for smaller development projects, but just, that information so that you're aware. So that's number 1. I wanted to take a minute. And actually, I should have said this at the beginning. Do not try to do all three of these, right? Like, don't take all three of these ideas and go and try and run with them. Here's how what I would view this lens through, or this is the lens I would view this information through. What applies to me in my market? Because I also I picked, and I've got a bonus. I actually have 4. I said we're going to do 3, but I have a 4th one. I tried to pick things that might be more relevant to all of these may not be relevant to all of you, right? So like there may be more opportunity for one-time close construction options in your market if you've got more land that's perked and ready to go versus the next option where it might be harder to make the numbers work on an investment piece, which I'll get into that in a minute. Point is, don't try and do all of this, right? I'm making you aware of these different options, but then find what is most applicable to you. And not only that, also run it through look at this and try and go through your database, go through your text and email conversations and DMs and see, are any of these programs relevant to people that maybe were interested and fell out for one reason or another, right? Like could one of these programs, and I'll give a very specific, for example, on the bonus one that I have, the 4th one, when we get to that, okay? So what you could do with this information, you can go and find all of the lots available for sale in your market that are buildable lots. And you can present them to your database. Hey, have you ever thought about building your dream home instead of buying a used one? Here's a list of available buildable lots, and oh, by the way, we have great financing options to build on your lot or whatever. I'm doing that off the cuff, but that's one strategy that you may do. Another strategy, if you want to get, if this is really resonating with you and you want to do more of these deals, you could use PropStream, go find vacant land in a particular area. Okay. Now I might use this strategy if I know I have a client that's looking for something in particular. Okay. Vacant land in a particular area, and you can build a list just like I did with the demographic circle prospecting session we did 2 weeks ago. You can build out that list and then reach out to them and simply ask if they would consider selling. And in fact, this is something I've been working on in the, in between these sessions that I haven't really been talking about, but I've been doing more on the vacant land front. And we've sent out some direct mail to those. And I've got this growing list of vacant landowners that have called me and either given me a price or told me information, many of which are buildable lots. So I'm building my own internal off-market list of vacant lots and land that when I have somebody that says, I'd really love to build in blank area. Oh, great. Right now we got 3 off-market options. I can send you all what's on the market, but we've also got 3 off-market options that might fit what you're looking for as well.
Hey, Josh.
Yeah.
If you have a builder that's interested in the program, is the builder the borrower, or is it the eventual homeowner that's the borrower?
Great question. So it could be either. So if you have a builder that wants to build a spec home, they would be the borrower. But if you've got a borrower that wants to build a home and we found a lot and we know who's going to build it, or we're going to put a modular on it or a manufactured on it, then the borrower would be the buyer would be the borrower in that scenario. Yep. So they would be essentially, they're getting their takeout financing on the front end. Like they don't have to make the full payment right up front of the full amount. There's a couple of different ways that gets structured. It can be staggered out, but it can be either or with those programs. Now, when I say either or, those top 4, they would be the actual borrower or purchaser. The bottom 3 would be if it's a custom builder, let's say, that those are more specific to their them building a spec home or even a small development of multiple spec homes. Does that make sense?
Yes.
Great question. Any other questions on this, on number one, before we go to number two, James?
Yeah, I think for where I'm at, we've got a lot of new construction. This could be good. Both finding sellers using our Dream Home Finder program. That's what we call it, when we go find off market properties. But
Yep.
the land can the MLS actually search for land, and do MLSs have the data for something that's ready, all stubbed in and ready to go?
You have to play with your MLS. So the answer is most likely yes, but I don't know the answer because I only have access to Bright, and you do have to play around with the different filters, and it also relies on the fact that the listing agent input it correctly, which is a little bit of a crapshoot. Yeah. So if you've got a client that is looking, and I know this is work, but you might go and find anything that loosely fits that criteria and call the listing agent to confirm, has this been perked? Is there water, public water available, public sewer available, things of that nature. And it's worth those conversations. And, you never know what else can come out from those, but you should be able to filter it with that. I guess my only point is those filters can be flawed.
Oh my God. Yeah. I gotta call NMLS after this anyway. I'm gonna ask them about that. But yeah, I've had I'm trying to filter down and it's glitchy, it doesn't work. I'm like, this is frustrating. Yeah. But so if that's a fail, is PropStream designed better for that?
Well, no. So with PropStream, you won't be able to search by buildable land. Okay, so you won't be able to filter out. There's not a specific filter to filter out land that can't be built on, but there are ways that you can use the filters to lower those chances. And then it's a matter of conversations, and you might proactively address that on the front end with your marketing by saying, we've got a client who's looking to build, who's looking for land to build on. And then you're only going to get responses from folks that have an idea that their home, is perked and ready to go. For example, I had a conversation with one of the landowners that called me back yesterday on some marketing, and they had it sold, but it wasn't perked. And they've previously had a failed perk, and we just went round and round and round, and I don't know where I was going with that, but those conversations. Now she was very standoffish, not wanting to work with a real estate agent, and kind of she felt like she had been fleeced by the last agent they worked with. And then by the end of it, she had talked herself into working with me, but she still had to figure out the perk part of it. Cause I didn't, I wasn't really interested if we couldn't figure out a way to build on the land. Like the land didn't have a ton of value or interest unless we could get a clear perk on it. So some of the answers to some of this just comes down to, it involves some work, which is why it's important if you're going to do that work that you have good reason to. I know this is kind of obvious thing, but if you have a ready, willing, and able client, that gives you more reason and motivation to kind of do some extra legwork and digging, et cetera, than, if you just have someone that, loosely replied to an email, let's say. So good stuff. All right. I'm going to keep it moving along here. Thanks, James. With number two. Now, this is a topic that we have talked about over the last couple years, but not one that we brought up recently on these, which is DSCR loans. Now, you may be, that alone doesn't mean a whole lot, right? DSCR stands for debt service coverage ratio loans. Okay. The opportunity is not in the loan itself. Here's the opportunity as I see it, is you proactively finding properties that will, what they call quote unquote, pencil on a DSCR loan. In other words, that would be lendable, that the property would be lendable. And then you go and find the investor client to buy the property versus working to get an investor client and then searching for a home. It's like you're reversing the process here. So how do you do that? Well, we'll probably do an entire session on this in the first quarter of January, but I just want to open your eyes to it, generally speaking. But just some things to think through when it comes to DSCR loans. Number one, they pencil way better with 25% down. So you want to have investor clients that have money, okay? We have DSCR options at 15% down, at 20% down. Occasionally, we get a lender that says they'll do 10% down. The problem is they don't pencil as easily at those numbers because it's risk reward. Easy for me to say. The higher the LTV, the higher the rate the lender's going to want, and then it becomes harder to get the property to cash flow. Okay, so figure on 25% down. And then an easy, now this is not universal, right? But if you want an easy way to, at least if you're looking through and trying to find properties that will pencil, an easy way is the monthly rent a 10-to-1 interval of the price? Meaning, and I'm probably saying that wrong because my brain, I've been sick all week. I've been sick for the last week and a half, but really the last 2 days, and I feel like I have brain fog. But if I've got a property that is, somewhere it's listed between 150 and 180, and the monthly rent on it is $1,500, I might take a closer look at it. Yeah. I might go look at, what are the taxes? What are some of the other variables involved here? Are the tenants paying for all their utilities, et cetera? And then figure out, will this pencil on a DSCR loan? Okay. Now, because I have several things that I want to get through today, I can't go super deep on this. But if there's enough interest, we can do a standalone session on this separate. Or if this is something that's like hitting a nerve with you and you want to explore it in more detail, just let me know. And what we can do is, if you have a property, we do what we call a quick quote on it. And to determine, does it pencil? And B, some like projected, what's the rate going to look like? What's the cash flow going to look like? How much out of pocket is there going to be? So that then you have basically a pitch sheet to take to potential investors on the property. Okay. Now, this is one that is going to vary greatly by market if there's opportunity here, because, the rental ratios and all of that, it's just, you see it just drastic difference by markets. Where I would probably look to start is 3 to 4, even up to 8 units. We can do DSCR loans up to 8 unit properties. I would probably look at those first to try and uncover, where there might be an opportunity. And again, if this is something that you'd like to dig into, I'd be more than happy to do that. But again, just to summarize, you're going to look for investors. Well, I'm sorry, you're going to go and find a property that you think will pencil on a DSCR. You think it'll cash flow with a DSCR loan. And just as I think if you use 7.5 as the interest rate, that's a good number to use right now, at least at the time of this live session, and whenever you're watching this recording, please note that 7.5%, 25% down, and they're going to look for a 1-to-1 or better ratio of the income from the property to the principal, interest, taxes, insurance. Okay, so if you can, you've got a $300,000 home. 25% down, it means we've got a loan amount of $225. Well, I'm not going to do the math on here because I'll screw it up. I don't want to do that here. But if you have scenarios or you want to explore this further, please hit me up, drop a comment, DM me. We can run those scenarios for you. And then the last thing is, okay, so I put this together. How do I go and find the investor? Well, start with your existing database, obviously. You can use social media, right? You can use PropStream to identify who in this zip code. In fact, this is where I'll get a little granular for a minute here. Let's say you find a good deal and you have no other way, you've exhausted the other options. You've sent in a deal of the week or some kind of email to your database. You've posted on social media, and let's say it's in this zip code. So I can go into PropStream and I can filter for folks that own. I'm still getting used to these new. There we go. These new, the new UI. But I could search for number of properties owned for. Okay, and look at that. I still have. Oh, that's the properties. That's not the owners. I could go to property details. I'm going to go residential, and I'm going to do. I want them to have other multifamily properties. So I've got 227 properties where the owners own multiple. Okay. You could also, this isn't ideal, but there are lots of other ways you could use this. You could look for cash buyers in that market and hit them up. I don't know. It may or may not be the ideal scenario, but it stands to reason if they already own that type of property in that market, that they might be open to buying others. And if not, maybe they're open to selling. So not a bad type of potential client to be having a conversation with. And then one other thought I'd give you is look at the other business owners, successful business owners in that general vicinity as well, because they're likely entrepreneurial and investment minded, and they might be interested in starting or adding to their investment portfolio. You never know. Questions on that one before I get to the third and then the bonus one as well? All right. Non-QM.
There was a comment.
Oh, there was.
Alana had a question in the chat there.
Okay, my bad. Are you seeing interest-only DSCR? Thoughts on that while rates are where they are now, so you have better cash flow and wait until 5 or 4% if those days ever come? Yeah. I don't know. I won't comment on that. But we do have a couple of options on DSCR that will do interest only. There is certainly risk involved with those. But they do exist. We have a couple of lenders that will do them. I would say that I would caution clients to do that, and I would want there to be a very good reason. And some of that might be market driven, meaning the local market driven, based upon what that looks like. But we do have those options. Generally speaking, we caution clients to steer clear of them unless there is literally no other potential solution. And James, yes, we call it the 1% rule. That was a much easier way of describing that. The ratio of the rental income to the purchase price, the 1% rule. Simple and easy. All right, good stuff. Number 3 on my list here, non-QM. Non-QM. Okay, so non-QM is simply loan types that don't fall under the traditional umbrella FHA, VA, USDA, conventional. We are seeing a growth in the number of non-QM loans being underwritten each year and honestly every quarter. Now, the total number of loans, I guess the increase is in percentage of mortgages, right? Because I caveat that because this year has been slow, generally speaking, but we're still seeing a growth in non-QM, or that portion of the mortgage industry. And the one there are lots of great non-QM uses for the small business owner, the 1099. We can use 1099s, we can use bank statements, we can use P&Ls, and so there's some great strategies with that. But one particular idea that I heard recently from someone else, a guy by the name of Brian Stevens, is the idea of helping more civil servants in your community with non-QM. And in particular, or the idea being, if they have additional income from, a side hustle or some other business that, the teacher has during the summertime, or the firefighter has or implements on their off time, we have ways that they can combine their traditional and their non-traditional income from an income qualification on non-QM. So if helping civil servants in your area is close to your heart, near and dear to your heart, and I think in many markets, given the prices of homes, it's more and more difficult for our civil servants to qualify. This is one way that you might help more of those potential home buyers, just looking at it creatively, and being just the simple fact that you're aware that this is a possibility when you're having conversations means you might be able to, I'll call it overcome an objection, but it's not really overcoming objection as much as it would be opening their eyes to other solutions. So you're talking with a teacher or some other civil servant, and the idea or the topic of buying a home comes up, and they say, well, I don't have enough income to qualify. Well, you can ask, do you have other income besides your teacher's salary? Because, we might be able to use that income to help with a pre-approval and get your qualification up and maybe open the possibility to other or more inventory to you. So just being aware of these things, I think, helps you have better, deeper, more meaningful conversations with people that you're, talking to about real estate. One bonus one I'm going to throw in here, and this is the one that I have several recent personal examples with this, which is FHA 203K and 203B. Now, there are other versions of these types of loans as well. I'd call these more fixer-upper or rehab loans. VA has a version of it, USDA has a version of it, and there are versions of it for conventional as well. So just be aware that, FHA isn't the only option on this. It's just that I've personally had some experiences with this recently where we've had clients come to us who had an FHA approval, and the approval amount was in a price range that there just was not a lot of inventory, in particular, inventory that was noted as FHA eligible. Okay. Now, again, this goes back a little bit to the conversation James and I had when he brought up a question. Some of that has to do with the listing agent and how they input a listing. But some of it is reality. I mean, they're at least in Central PA, we've got a lot of inventory that's older homes, and they may not be FHA eligible, or the seller may be unwilling to make any repairs or do anything to bring it up to code, even though there may be simple solutions. Well, I've had two of those scenarios recently where we opened up the inventory to include properties in their price range that weren't noted as being FHA eligible, and had the conversation with them. Hey, there may be a scenario where we can purchase one of these with a FHA 203K or 203B. And I just got some notes here on the difference between those in a minute, where we can make those renovations. And two things from that. Number one, we open ourselves up to more possible inventory. And number two, you may walk into some equity, because some of the times with these, we can address some simple issues and improve the equity to a point where, you know, the appraisal, the after repair appraised value may be significantly higher than the current asking price. So both of those, we don't have either of them under contract yet, those scenarios that I was talking about, but they had pretty much given up is why I'm bringing it up. And this was a way to get them sort of back in the game and serious about looking. And I would anticipate that if we don't get them under contract before the end of the year, we certainly will in Q1. So just some basic differences. The 203B is kind of like the light version, and the 203K is for significant work that might need to be done. So 203B can be for things like new appliances, fixing gutters, roofs, and downspouts, door and window replacements, HVAC system repair or purchase, electrical and plumbing repair or purchase, floor improvement or replacement, right? So like replacing carpets or new hardwoods, things of that nature. Interior, exterior painting, chipping paint is something that, you know, if a house has chipping paint, the seller may say, well, you know, I don't want to deal with it. Let's just not make it available to FHA. Well, that's an easy fix. And not only that, but I've had FHA borrowers that have actually done that work themselves to address it, right? So like, you know, if they want it enough, well, we can figure out a way to make it work. Anyway, you can see here, small stuff. The 203K is for more major things, like entirely rewiring the electrical in a property, or significant water damage or flooding issues. You can even use a 203K for a property that has foundation issues. Sorry, the screenshot on this one is really small. So could deal with foundation issues, damage to sidewalk or driveways. Those are things that can be, you know, quite expensive. Wood destroying insect damage. It's not just termites, right? There's other wood destroying insects. If it was an older home and there's lead hazards, you can see all here, right? I mean, the point is, the more options and the better. Here's really the big takeaway. If you're a better problem solver, a more creative problem solver, you're going to find more ways to help more clients. And so it's about proactively, making you aware that some of this stuff exists, and then you figuring out, where can I proactively put some of these opportunities together? So one last thing on this one, and then James, I'll get to you. You may go and find a list of fixer-uppers in your market, and then use some of the same things I mentioned, emailing your database, texting your database, social media. Hey, I put together a list of fixer-upper properties that might qualify for special fixer-upper financing. Is that something you'd be interested in? Let us know and we should chat. And by the way, I need to do that. I haven't done that in a while. I might actually do that with an email blast tomorrow. That very idea. James.
This is good timing. In fact, I was going to bring this up. I've got a listing that needs a bunch of repairs, and I've gotten some buyer leads out of it. Some they don't have the money to do the repairs, and it's pretty significant repairs. In fact, one of the buyers was lined up with a VA loan, and I guess the lender actually went by the property and was like, "No, we can't do this. There's too much to do."
Yeah.
So I just texted the buyer agent. I'm like, "Hey, can you get them from that VA over into this 203K to see?" But I do have questions about the.
Well, hold on. So I want to unpack a couple of things on that, but don't lose your questions.
Yeah.
So some lenders won't do certain different criteria of loans, or they prefer not to. Let's say that. So when I was talking about the one-time close construction options, we have one lender in particular that kills it with those. They love it. It's their thing. It's their sweet spot. We have others that'll do it, but like, of the 200 plus wholesale lenders we have at NEXA, like there's one of those that really like they'd prefer to do it because there's more red tape. There's more to it, right? And so that is a lender, most likely, that likes the easy, don't have to work outside the box, because VA has a version of that. I forget what it's called off the top of my head, but VA has a fixer-upper style of option that they could have explored with that client. That's either the lender not being aware, being lazy, whatever. I don't know. I don't want to throw them under the bus, but like, there are way more solutions out there for the motivated folks than what many realize. There was one other point in there, but maybe it'll come back to me when you have your other questions.
That's good to know. I didn't know VA had a program like that.
Yep.
So just for some clarity, I was told the 203K had what sounds like you're saying there's a 203B. So it was explained to me that if it was like under $30,000,
35.
35, that's kind of like the B version, right?
Yes.
And then if it's like, what is it, up to 120,000 or something? Level?
I have to double check on the max limit on that. And I think
Something
that
like
is
that,
also
right?
one that varies by the FHA limit for the area.
Yeah, that would make sense.
Okay. But here's the thing, on the 203B, it can be like small. It may be something super simple that is keeping that property from being FHA eligible. And it might be a $2,500 repair, but the borrower just may not have those extra funds. But in that case, that's a very simple one that, you can make something happen for someone that may not otherwise be possible. So this was the other thing I was going to mention. You can combine some of the other, you can combine down payment assistance with the 203B as well. So again, you're adding more red tape. It becomes a little bit more tedious, in particular for the borrower, because that's who the red tape ends up falling on most in reality. But if you have someone that's motivated and they've been trying and it just keeps striking out because, all of the pretty houses are getting bids that they can't compete with, there are ways to work around that.
Two things. My understanding was that, especially with the 203K, the bigger ticket one, it's got to be general, GC's general contractor licensed doing
that one. Yes, there's a lot more red tape with the 203K that you have to have an FHA counselor essentially involved. It has to be licensed contractors, et cetera. Yes, that one is there's a lot more red tape with that one. But that one also, you can do things like that weren't even mentioned on there. You can do you can put in a pool. You can put in an outdoor kitchen. You can get pretty creative with how you can use that. As long as you can justify the value in the after repair appraisal.
Gotcha. One other question too. So this is kind of getting around the rules where it doesn't have a handrail. It needs to be put in. It allows them to actually move in even though that handrail's not in yet? Or do they have to wait to have the repairs done before they move in?
So there would be a little window that they would have to have that done.
Okay. Yeah. It makes sense. They're looking out for that client. Okay, cool. Yep. All right. Went down in the weeds a little bit, but I think that's
borrower has to live in the house for a certain amount of time. They can't
FHA.
Oh yeah,
they got to live in there for a year. Yep. That's different though. I'm just saying up front, if it doesn't qualify because there's safety issues that aren't covered in the FHA guidelines, they're going to have to be dealt with.
You can also use them on a multifamily if the borrower is going to be living in one of the units too.
Yeah, so and that's 3.5% down, right?
Yep.
That's great.
Yeah, no doubt. Any other questions, comments?
Yeah, I have a question. Is the 203B and the Ks and all the ones that you have to qualify for both at one time, right? So like, can
Well,
you hear
you're
me?
qualifying for the after repair, the projected after repair appraised amount.
Okay, so
Yeah.
they have to. So the principal of the main loan plus the fix up loan is in totality. You know,
Correct.
they would have to. Okay, and
Yep.
then is typically the fix up loans like the 203Ks and Bs. Do they have a different interest rate than the base loan that they partner with?
Uh-uh.
No. Wow. Okay.
Nope.
Interesting. Thank you.
Yeah, you bet. Good questions. I appreciate it. I did not. I have something at the top of the hour, so I don't want to get into the what I was going to do, and it's kind of bouncing around on this session, right? A little bit all over the place. But what I was going to do, Fernando had brought up when we had Burton on last week about using PropStream to find on-market properties that some different strategies to use that as a way to filter on-market properties that maybe trying to find a good deal for a buyer or whatever the case may be. I'm going to save that, and I'm just going to record some ideas with that as a separate standalone, and we'll just kind of start to come in for a landing on this one. I don't have a topic lined up for next week. I've kind of fallen behind there, probably because of the holidays. We had been doing a good job of having those lined up. So you'll just have to keep an eye out on your inbox when we come up with the topic for next week. I'll let everybody know. We've just been updating the existing Zoom session. A couple of you have already texted and DM'd me to chat about some of these ideas. And so I would encourage you, if you're curious or interested, to do the same. I'd be happy to strategize, chat about some of these different solutions, maybe even get you connected with somebody on our team that, if you have more specific or detailed scenarios or situations that you want to explore. And I appreciate James. Thanks for the questions and the interaction, and Cheryl and William as well. And I know we're getting, as we get closer to the holidays, attendance on these teams seems to waver a little bit. But the last thing I'll tease is I am working on something that I'm pretty excited about as a more intimate way for us to stay engaged as a community, potentially even share referrals, updates, etc. And it will be 100% free as well. And so as soon as that's ready to release, I will let you all know, but it should be sooner than later, and you'll all be the first to know about it. We'll still have these mastermind sessions every Wednesday at 11 a.m. Eastern, and hope you all have a great rest of the week, and look forward to chatting with some of you, and hope to see you all next week, same time, same place.